To follow along with the calculations in this chapter, I suggest you either open or print the Chapter 11 Case 2019 Excel file that I've posted with this unit in Blackboard. It pulls all the steps of building the cash flow estimation into one cohesive spreadsheet page, and I think it'll make it easier to see how everything fits together. Plus, it actually follows more the form you would use to build a capital budget in Excel, with all the given data at the top so it can be easily changed for what-ifs, and everything below the red line calculated. We're going to return to calculating NPV, IRR, etc. But first, we have to learn how to estimate the cash flows we want to analyze. Our basic chart keeps us focused on where we are in the big picture, estimating the project cash flows. Here's the data for our sample project from the mini case. The firm is considering adding a new product line. This and the next slides provide all the data we'll need to develop our capital budget. This slide describes the equipment to be purchased and how it will be depreciated. We're provided with the sales price and cost data. Note how net working capital is specified as a percentage of the expected sales the following year. The first thing we need to understand is the concept of incremental cash flows. In evaluating an investment opportunity for a firm as it relates to the rest of the company, we're only interested in what is added to the firm from the project, additional or incremental cost and incremental revenue. Changes in net working capital are definitely relevant. Typically, a firm needs to invest in inventory, and accounts payable will spontaneously increase, causing a rise in net working capital. Note that any increases in net working capital will be recovered in the last year of the project. Interest and dividend expense is not relevant. The cost of funding is included in the weighted average cost of capital. Sunk costs are not relevant. If it's already been paid for or committed for, it's not included. Opportunity costs usually relate to a firm already owning a building or land that could either be sold or used for this project. This is not free. The cost is the next best thing that could be done with it. Externalities are usually cannibalism, a new product taking sale from a current one. Externalities can be positive, but usually they're not, and they are a cost to the project. And finally, tax effects. In finance, we are always concerned with after-tax cash flow. We said that interest and dividends should not be included in our cash flow estimation. That would be double counting. We always assume all investments are funded by the same percentage of debt and equity as the firm, and that's reflected in the cost of capital. Sunk costs are truly history. They should have no bearing on future decisions. It's easy to think, but we spent so much on that already. That money's gone, and it should not influence a decision about the future. Opportunity costs typically involve fixed assets that can be used by the new project or sold, rented, leased to bring in income. That lost income is an opportunity cost and must be charged against the project. Cannibalism is a frequent occurrence. Firms typically build on a successful product with enhancements, new versions. Think Apple. Cannibalism is a cost to the new project, but should not be considered a negative in a strategic sense. Continually introducing upgrades and new products is the lifeblood of business. Back to our sample project. The depreciation basis for a fixed asset includes the cost to acquire it, plus any shipping and installation charges, whatever it takes to place the item in service. The depreciation basis for our project is $240,000. Using the IRS-mandated Modified Accelerated Cost Recovery System for a 3-year class item, we'll apply the given percentages over 4 years. Modified Accelerated Cost Recovery specifies a half-year convention, assuming that all assets are placed in service in the middle of the year they're acquired. So a 3-year asset is depreciated over 4 years. The depreciation charged each year is computed as a percentage of the basis. Book value is the original basis minus the accumulated depreciation. This recaps data with a 3% inflation considered in both unit price and unit cost. Note that while the units do not increase, both sales revenue and costs do increase with inflation. When estimating cash flows, it's important to consider expected inflation. The cost of capital is based on nominal rates, which include an inflation premium. If cash flows are not adjusted for inflation, it will bias the NPV downward. Real cash flows have no inflation adjustment. The nominal cost of capital has inflation built in. There are 2 ways to adjust for inflation. Adjust the weighted average cost of capital to remove inflation. While this might seem like the easiest way, change one number, It implicitly assumes that all cash flows, all line items, are affected by inflation in the same way. And we know this isn't true. For example, depreciation isn't affected at all. The preferred method is to adjust on a line item basis, since inflation may impact the selling price at a different rate than the costs. Adjusting cash flows as required for inflation is the preferred method of incorporating inflation into our cash flow estimation. And here are our calculations: sales, costs, depreciation, resulting in EBIT, apply the tax rate, NOPAT, net operating profit after tax, for years 1 and 2, and years 3 and 4. Now, note, NOPAT, we must add depreciation back. Depreciation is a non-cash expense. We include it because it affects taxes, but we're looking for cash flow. We add it back to get operating cash flow. The investment required in net working capital was defined as 12% of the expected next year's sales. What that means is the total investment in net working capital must equal 12% of the following year's sales. So for year 0, that means 12% of $200,000, $24,000. For year 1, the total investment required is 12% of $206,000, or $24,720. But you've already invested $24,000, so you only need to invest $720 more. That continues for years 2 and 3. If there's no investment in year 4, you recover all of your investment. When the equipment purchased in year 0 is sold in year 4, there may be tax on the salvage or market value. Tax is paid on the difference between the salvage value and the book value at the time of the sale. Since this asset has been depreciated to a book value of 0, the total salvage value is a gain and is taxable at the firm's 25% rate. If a project is terminated before a fixed asset is fully depreciated, then tax is owed on the difference between market value and book value at the end of the year the project is terminated. Note, this formula is not in the textbook. It's explained in words, but there's no formula given. Net salvage value can be less than the salvage selling price if the unit is sold for more than book value and taxes are owed. Net salvage value can be greater than the salvage price if the asset is sold for less than book value and taxes are recouped. This formula takes care of either situation. What if we terminated the project in year 3 and sold the asset for $25,000? We'd owe a tax on the gain, 25 minus 17.8, so our net cash flow would be 23.2. If we sold the asset for $10,000, we'd recover tax on the loss versus the book value. In this case, we'd recover tax, so our net cash flow would be $11.95. Recapping where we are now, here we are for years 0 through 2 and years 3 and 4. Note the recovery of net working capital and salvage inflow in year 4. These are our final cash flows for years 0 to 4. These are the numbers you enter to find NPV and IRR. I'm pretty sure you can't see much on this slide. This is the file I suggested you open in Excel or print out. I want you to see how all the parts we've been calculating fit together. All the given data is grouped at the top, so if you need to make changes, you make it in one place and it flows down through the whole worksheet. Depreciation is calculated in the second area. After-tax salvage value below that, and the total required investment in net working capital below that. With all these calculations done, in the cash flow estimation area, we use what we've computed above. The bottom of the sheet contains the analysis, NPV, IRR, etc. To find our project's MIRR, not in Excel, we need to future value all the inflows for years 1 to 4. This slide shows the process on a timeline. Remember from Chapter 10, TI Business Analyst 2 Cash Flow Worksheet does not do future value of an uneven cash flow stream. But we can find it, a couple of steps. Step 1, enter only the positive cash flows in the CF worksheet and find the NPV as usual. Step 2, move the solved for NPV to PV. Press the clear key to exit the cash flow worksheet. 326,592.77 should still be displayed. Press the plus or minus key to change the sign. Press PV to place the value in the present value cell. Enter the rest of the variables. N is the number of the project. 4. Discount rate, 10. Payment is 0. Press compute and future value. Future value of the cash inflows is $478,164.47, which is already in the future value cell, which is where you want it. Again, be careful if there's more than one negative cash flow in the cash flow stream. If so, the negative cash flow must be discounted back to times zero and added to the initial outflow. Also, when entering the cash flows in the cash flow worksheet for step 1, the negative cash flow must be accounted for by entering a 0. We now have all the variables to find MIRR. Simply use the TVM keys as shown and solve for IY, which is the MIRR. Fortunately, as you remember from Chapter 10, there's 2 ways to find it in Excel. If you do all the prep work to find the future value of outflows and the present value of inflows, then the rate function works just fine. Remember, Excel has an MIRR function. Note that it has 2 rates, financing rate, which is the discount rate, and a reinvestment rate, the future valuing rate. For our examples, these will always be the same, the weighted average cost of capital. And it does solve the internal rate of returns reinvestment rate assumption and the multiple answer problem. For the profitability index, we'll use the present value of the inflows we found for the MIRR calculation as the numerator. The denominator in the PI equation is the absolute value of the initial cash flows, meaning make the negative $264,000 positive. Thinking back to Chapter 10 again, here are the calculations to find payback. Accumulate the cash flows and find where the sign of the accumulation changes from negative to positive between years 2 and 3. So the payback is year 2 plus the absolute value of the last negative accumulation, minus 67, divided by the cash flow expected in year 3, 88, resulting in a payback of 2.8 years. In the same manner as in Chapter 10, to find the discounted payback, discount each year's cash flow and then accumulate and follow the same method as for regular payback. Remember, the final sum of the discounted cash flows must equal the project's NPV by definition. Discounted payback will always be longer than regular payback. And if the project has a negative NPV, then discounted payback will not be defined. This ends Part A of Chapter 11.